Hey everybody, welcome back to a Tax Talk Unfiltered. That's another episode. Usually Spencer is with us. Right now he needs to take care of his little baby, so he took a couple of hours off. But we're excited to talk about the latest updates, about the one big beautiful bill that is coming up soon. Before we get into the details, a disclaimer, this bill is still in discussions. We are going to discuss basically the latest Senate update of the bill, what's going on, how it might affect some of the taxpayers with specific focus on businesses and business owners in this one. It's quite an exciting bill. It's a bittersweet taste to it so far, and we're going to review some of the items there. Rachel, do you want to give a quick background about TCJA or in general?
Yeah, so one of the main implications of the bill is extending the legislation that was passed in the Tax Cuts and Jobs Act. So the Tax Cuts and Jobs Act, which passed back in 2017, it lowered tax rates, it doubled the standard deduction, it increased the estate tax limitation, and capped the state and local tax deduction, among many other things. But a lot of those provisions that were passed in that tax bill were phased out or set to expire at the end of 2025. So that's why this bill is really important. One of the main things that it's doing is extending or making permanent a lot of those provisions. So, for example, having the highest tax rate at 37% instead of 39% would become permanent, doubling the standard deduction, and then changes to the state and local tax are things that would become permanent from that original bill.
Yeah. There are many things to unpack there, but as you said, like the tax rate is basically permanently going down according to the current version. However, they did talk about like changes for the state and local tax. Do you want to give us a quick overview about that and who it usually affects and what's going to happen there?
Yeah, so back when they passed the Tax Cuts and Jobs Act, they originally you could deduct unlimited state and local taxes as an itemized deduction. And then with the Tax Cuts and Jobs Act, they limited that to $10,000 of state and local taxes. In response to that change, a lot of states that have high income taxes, they created workarounds where instead, if you had a business, you could pay state income tax from your business and get a federal tax deduction. So you could still end up getting a deduction for paying those taxes through your business and not lose out on the tax altogether. So one of the changes in the proposed legislation would eliminate some of those workarounds with the PTE tax, which could have a huge impact for businesses in high income states that might be enjoying the benefits of that current workaround that we have.
Yeah, thank you. And it's important to emphasize like how big it is. Like let's get an example. Let's say that you're a business owner that makes about $1 million a year, living in California right now, and before basic, and you're going to pay a lot of state taxes. California is very aggressive. New York, California, those states are very aggressive about their state taxes. You're going to pay 6 digits on state taxes in California on that income. What happened when they enforced basically the SALT limitation is that you would not be able to deduct the state portion, that's, let's say $120,000 from your state taxes against your federal taxes. Since your federal taxes are quite high already, let's say 35%, 37%, depending how you file, like it means that basically you would have paid like about a bit more than $45,000 more in taxes since 2017 after the change. The workaround that was created by the states, the PTET, allowed you to still take advantage of that regardless of the change, and that's something that it's on the table and going to be eliminated. It means that in this case, if they actually successfully eliminate the PTET workaround and there is no any other option or any other workaround that is being created by states, it means that like high income taxpayers, especially business owners, are going to pay additional, in this example, 40 something thousand dollars in taxes just because of that. So it can be quite significant for a lot of architecture firms, law firms, and any flow through or pass through entities like partnerships and S corporations around in those high income tax states. So it's going to be interesting to see what's going to happen after that. And of course, if it's passed, it's going to completely change the dynamic of how we're thinking about strategy, like entity selection. Suddenly, certain entities might not be the right choice for those states. It's really going to change the dynamic if it's being passed. So that's quite dramatic. But we'll see what happens. We'll see what happens. But let's move to the next item. And of course, by the way, if you have any questions, just write a question in the comments, and somebody from the team, either me or Rachel or somebody else, is going to answer those questions. So let us know what you think. Let's move to the next item, bonus depreciation.
So, bonus depreciation, to give a little background, was another change that was implemented with the Tax Cuts and Jobs Act. So, in the past, you could deduct up to 50% bonus depreciation. So, that means if you bought equipment or other type of property, instead of depreciating over, say, 5 or 7 years up front, you could take something called bonus depreciation, where you could deduct 50% up front and then depreciate the rest over many years. With the Tax Cuts and Jobs Act, they increased that bonus depreciation to 100%. But since 2023, it's been phasing out each year, getting closer and closer to zero. So we went from 80%, 60%. We would be going to 40% if there were no changes. With the proposed legislation, we would permanently go to 100% bonus depreciation. So 100% of qualifying equipment or purchases could be expensed in the first year, which is almost like how Section 179 depreciation is treated. But bonus depreciation will count against your, say, ordinary income, where 179 is treated completely differently.
Thank you for the background. And like just to put it into perspective, like a good example would be like if you're buying a car for the business, or if you're buying heavy equipment. So if you ever probably heard about like, oh, if you buy certain vehicles over 6,000 pounds, you can depreciate the whole thing. Though that's what it will affect. So over the past couple of years, the depreciation amount went down. This, if it's fast, it means that it's back to 100%. So more people will buy probably heavier vehicle. That's the number one. But another good example, let's say that you're a private practice physician and you're starting a new location, and you're setting up the location, and you need to buy a lot of like very expensive equipment, because those medical equipments are quite expensive. You might be able to, instead of depreciate that and recognize that over time, you'll be able to take everything year number one as an expense, which is very exciting for in those cases. So that's another example of like how it will be very beneficial for business owners.
It can also be really helpful with cash flow, because you can take that 100% bonus depreciation even if you bought something that, say, you financed. So even though you might not have the cash outflow of making a $50,000 or $100,000 purchase, you can get a $50,000 or $100,000 deduction if there's 100% bonus depreciation in play. So you can really get, the most out of the initial year that you're buying new equipment.
That's a great example. Rachel, can you be more specific about that? Like give an example with like a specific equipment and how this kind of like transaction would look like with that provision. Like if I'm buying a new, like let's say, I don't know, a physician chair for like $20,000, what would happen in that case?
Yeah. So if you were buying, let's do a car. So if you were buying
Okay.
a heavy vehicle and it's $80,000, if there was no bonus depreciation in play, that vehicle would qualify probably for Section 179. So you could deduct the first $25,000, and then the remaining $55,000 would be spread over the next, five or so years, with bonus depreciation. So in the first year, you'd be
I,
getting a deduction of about $36,000, versus if you can take the 100% bonus depreciation, you can get an $80,000 depreciation deduction in the first year.
And if we connect it to the financing, you can get like $80,000. Let's say that you're putting a down payment of like $10,000 on the vehicle, and then you're paying monthly whatever amount that you'll need to pay monthly depending on the loan term. You will still be able to take the $80,000 as deduction, even if you didn't pay cash for that, and that's a big
Mm-hmm.
one. So basically, you get the tax deduction when it happens, but you don't pay for that when it happens. And also, it's important to mention that the interest on that purchase is also deductible. So not just that you take the value, the $80,000 of the value of the vehicle as an expense for that year. Basically, you recognize it in the same year that you bought it. In this case, also like the interest that you're going to pay for that car is going to be deductible as well. So that's a really cool way to think about that, especially with high income tax years. So if you know that you have like a big year and it's November, December, and you happen to need a new vehicle for the business, that can be a strategy how to buy the vehicle but finance it or pay for it a little bit with your tax money. It's a really cool hack.
In that example, you would be paying $10,000 and you would save almost $30,000 in tax. So you would come ahead like almost $20,000, which is really cool.
Yeah, yeah. Let's move to the next one. Qualified business income deduction or Section 199. Hey, want to give a quick background on that?
Yeah. So again, with the Tax Cuts and Jobs Act, this was a new deduction that was introduced that has been it's been slowly phasing out in terms of the income limitations that apply to it. But the qualified business income deduction, again, for those pass-through entities, so S corps, partnerships, even disregarded entities, so single member LLCs, your profit from the business, you can get a deduction of up to 20% of that profit against your taxable income. So if you have a business that has $100,000 in profit, you could potentially get a $20,000 deduction and end up paying tax on only $80,000 as a result of this deduction. There are lots of limitations and details inside there, but to simplify, that's the idea of the QBI deduction. One major change from this is that instead of 20%, we would bump the amount of the deduction that you get up to 23%, and then also ease back on some of those phase out limits so that more high earners and successful businesses could have access to this deduction.
Thank you. Thank you. That's a big one. Like a lot of people don't know how to quantify that because it's something that we are taking at tax time. You do not really take that into consideration during the year, beside the planning and knowing that it's going to happen. But it's quite a big one for many businesses. It's a great benefit, especially for the businesses who are eligible for that. Actually, recently we were on a podcast for architects, and I actually learned that architects are eligible for this deduction. Usually, professional services are not eligible for that. So, great job, architects, for having the right lobbyists, basically. Good job on that. That's a good one.
One more thing to mention about the QBI deduction, one of the intricacies of it is that it's really limited to 20% of your business income or 50% of payroll. One of the benefits of an S corporation is usually, if you have a lower payroll, then you save the taxes. And some people think, the lower my payroll, the better my outcome will be. But having this qualified business income deduction kind of brings another layer into that where you want to have higher payroll in order to qualify for the deduction. So if the deduction is going to be increasing, that also might change the optimal payroll amount where you can get the most benefit from that deduction. And that's either paying yourself or paying employees, but definitely something to consider and incorporate in your planning strategy for the year if this goes into play.
Yeah, thank you. And it's matched really well with also retirement planning as you do that. So
Exactly.
definitely something that we are looking forward to see how it happens with it and what will be the final basically phrasing of that part of the law. Okay, the next one is QSBS, Qualified Small Business Stock. I will take this one. So qualified small business stock is a really great benefit for certain business owners. It's basically for shareholders of C corporations that fall under very specific criteria about the business operation. So I think a lot of the startup companies that you hear about, the founders and the investors of those companies, especially the early stage investors, they are eligible for the QSBS. And traditionally, the QSBS, under the right circumstances, give you $10 million exemption. So basically, if you sell the company for $20 million, and you are eligible for that, the first $10 million are fully exempt and you don't need to pay federal taxes on that. Also, you don't need to pay state taxes in certain states, not in California. But that's basically what QSBS is all about. I'm sure that many of you already heard about that. It's a really great benefit. They're talking about expanding QSBS. When there are two areas that they are looking into changing QSBS. The area number one is the exemption amount itself, which is like from $10 million to $15 million. So it's basically extra $5 million that you might not need to pay taxes for, which is it's pretty great. It's a really great benefit for a lot of people, for the people who are eligible for that. And the second thing, in order for a company or for like a shareholder to be qualified for QSBS, they need to invest quite early into the business life cycle. And the definition of quite early is up to $50 million of assets. So if you look at your financial statements, specifically the balance sheets, you have like assets category there, up to $50 million of that category for the business if the investor invested up until that point, or the employees, or the founders, or if there are new founders coming in, they might be QSBS eligible for this really great tax break. And they want to increase the threshold from $50 million to $75 million, basically allowing more businesses to fall under that category, which is really awesome. We'll see what happens there, but definitely that will incentivize more people to join early stage companies. So I think that it's, of course, objectively, I think that it's a really great way to incentivize people to join early stage businesses, which is awesome. Maybe one thing that I didn't mention, of course, you have the $10 million exemption, and that might be $15 million after this bill. We'll see what's passed. But there is also like the 10x basis. So if, for example, you're an investor in an early stage startup and you invested $5 million into the company, you're getting actually $50 million of tax exempt, assuming that it's QSBS eligible tax break. So it can stack up to quite a large amount. So you can get for great risk. If you are in the happy case that the risk paid off and you have very large payout, you might be eligible for quite a lot of money completely tax-free from a federal perspective. But that's about the QSBS eligible one. R&D expenses. Rachel, do you want to take this?
Yeah. So back in 2022, there were changes to the R&D, research and development credit, and how you treat the research and development costs. Currently, you need to amortize those costs over many years. So, for example, you have engineers outside the US, you would be taking those deductions over many years, and then with this change for domestic R&D expenses, you can expense those automatically. So you can take deductions faster and again improve the cash flow of your business by reducing taxes. Do you have anything to elaborate on that? Because I know that one's pretty close to you, Tal.
Yeah. So R&D, basically expenditure, it's section 174, by the way, if you're looking at the code. It's about cash flow, especially if you're getting to be profitable or you're almost profitable. Imagine that you're spending $1 million on R&D and most of your engineers are outside of the US. Currently, you will need to amortize. Amortize is kind of like the depreciation for non-tangible or intangible, basically, assets. But you'll need to amortize those $1 million over 15 years. So if we take a more rounded number, let's say $1.5 million, you will not, even if you spend $1.5 million, you'll not be able to recognize that as expense. You'll be able to recognize every year for the next 15 years $100,000, and that's like step by step. Like that's basically how you would recognize that expense. It's becoming a problem, especially if most of your expenses are R&D, let's say the $1.5 million, but you add $1 million of income. So if you had $1 million of income and $1.5 million of R&D expenses, supposedly you're losing $500,000 a year in cash flow, which is the situation of a lot of early stage startups. However, because of the amortization, for tax purposes, it will look like you made $1 million, but you were able to basically expense only $100,000. That's a big problem because those $900,000 that might be considered profit if there are no other expenses, of course. Those $900,000 may be subject to corporate tax, and corporate tax is 21% right now in the US. So it's quite a lot of money in taxes to pay. Of course, there are strategies around that and to think it through, but it's really something that is very limiting for a lot of early stage companies, especially if they think that they're not profitable, but they end up actually accounting or tax-wise to be profitable. So that's definitely something that a lot of people and new businesses should take into account. And I think that the changes that they want to create in this one, like basically to make it zero from 5 years amortization to zero, like just expense it right away on domestic R&D, and it's going to stay 15 years for foreign R&D. So if you're a US business and you have an R&D in Europe, for example, suddenly you will not be able to recognize that expense as easily. But for US engineers or US workforce, you'll be able to just expense it right away. It's a big
So
change, and a big, yeah.
it's also an incentive to bring work to the US.
Yeah, so that's basically one of the ways that Trump defined as America first. That's definitely a law that puts America first, and it actually creates incentives for a lot of tech companies, especially startups, to bring the R&D into the US as opposed to keep it outside of the US.
Do you want to talk about some of the things that are popular online that I know we talked about might not really be relevant for high earners?
Sure.
Okay. Well, the 5 second version is there's the elimination of taxes on tips, overtime, social security income, deduction for car loan interest. But all of these things, realistically, if you're a high earner, a business owner, they sound cool, but they probably won't affect you. The takeaway is really just don't be distracted by what you hear online, because not everything's going to be relevant for you.
Yeah, and the main reason that's not going to be relevant because they're doing phase out clauses to all of those basically sections. So basically, if you make more than a certain amount, you're not eligible for that section at all. And also like maybe one thing that is important like to talk about for a second, the overtime, no taxes on overtime. Come on. Like it will make everybody to work for minimum wage, and suddenly everything else is going to be overtime. And again, it will be phased out, but it's not. I'm not sure. Like I'm not sure if it's the smartest use of the legislator time to define this kind of stuff. I'm not sure if it will affect that much higher earning like individuals overall, and it will just create a lot of situation that it will be much harder to prove what is overtime, what's not overtime, and it will change the way that contracts are being defined. So I think that the no tax on tips and the overtime thing sounds theoretically okay. If you really think about it, it's quite stupid. So that's those two. I'm not sure if I'm like there are more important things to do. Let's put it that way. I think that the last item that I want to cover is how all of that actually affects you or affects like our clients or affects like if you're a business owner, if you're a private practice physician or an attorney and you have your own office or a startup, how all of that affects you. So for companies that tend to be a flow through entity or pass through entity like S corporations and partnerships, it really depends on the state. Rachel and I actually are based in Florida, so the state and local tax limitation didn't really affect us that much. But people who live in New York, people who live in California, people who live in Illinois, and any other high state income tax place, it's going to be significant. Suddenly you used to get like a couple of tens of $1,000 sometimes of deductions from taking advantage of the workaround for the S corporations and partnerships. You will not be able to do it anymore. It means that you will have a couple of between, like, on the best case scenario, a few thousands of dollars extra on your taxes. On the worst case scenario, it can be tens of thousands of dollars and even 6 digits extra on your taxes in those scenarios, in those cases. It's really going to be significant. And when that happens, we need to start asking ourselves, when is the threshold that S corporation and a partnership does not make sense anymore, and we should start to transition into C corporations, where you're going to get hit with double taxation, the 21%, maybe like something for the state, and then the dividends, whatever you want to take home, but it might end up with less taxes compared to basically just being a partnership. So that's kind of like, I think, the main thing that we're going to ask ourselves, depending on how it will end up and what will be the changes and how much money our clients are making. But it's definitely something that will need to be reviewed again in the and maybe like change the entity selection. Changing an entity selection, it's a big thing. It's not something that it's super simple. Sometimes it's a one-way street also, and it's really hard to roll it back. So it's not something that you do lightly, and it's something that needs to have a very careful planning around. But it's definitely something that we're going to start considering, assuming it's going to change. Um, for startups, it's really, we covered that very briefly. But for startup companies, like, where do you do your R&D? Are you staying fully distributed? Are you putting R&D offshore? Are you going to bring it back home? Because of the difference in taxes is going to be significant. So it's going to raise a lot of operational questions for companies. What's more reasonable for them to do? What's less reasonable for them to do? But I would say that those are the two main areas that, in my opinion, would be significant. And of course, there is all the assets related, but assets is more like a candy that is being given to companies, not so much as like a big huge strategic decisions in most cases, not in all cases, but in most cases. Rachel, do you have anything to add to that?
No, I mean, it sounds like if you're a business owner and this, depending on what actually goes through and becomes law, it'll be a really good opportunity to rethink your business structure and also what you're taking in terms of deductions, because this could open up a lot of opportunities to optimize both of those situations.
Yeah. Okay. I
Yeah.
think I think that's it for today. Of course, another disclaimer: this is not final. It passed the House. Now it went to the Finance Committee in the Senate. They put those notes that we just discussed, that it's going to be back in the House for further discussions. And it might change again and again and again until it's being passed on time. Don't make any changes right now. That's the best probably advice that you can get out of this call. Wait until everything is set in stone and and completely passed before you make any actual changes to your structure. But that's another episode of Tax Talk Unfiltered. Thank you, everybody.